Hey, hello, and welcome everyone to Trading Coach's Playbook. This is Brandon Wendell with you. And before we get started, just need to remind everyone that we are not broker dealers or investment advisors. We're going to be looking at the markets from an educational standpoint, which means I'm not telling you to buy, sell, or hold anything or giving any personalized recommendations about the markets. All markets do involve the risk of loss. That's always a situation. We can never eliminate the risk. We just try to minimize and manage it. And we're not subject to trading restrictions. We got positions in securities or initiate some at any time. Actually, let me just do something real quick. And let's see. Which one did I just open? Yep, that's the right one. Okay, so basically, yeah, I just had to update and wanted to share with you guys some of the stuff that we're doing here. Got a lot of programs available. We got premium online workshops as well as free online workshops, and I'm busy pretty much every single week, educating and mentoring in the E-mini think tank. So I'm going to talk about some of the programs and stuff that I do in the E-mini think tank a little bit today because I figured I'd talk a little bit about broad market and how to manage some of the risk and about options on futures because we've been doing a lot of focus on that particular subject. And I actually created some tools that are available for students inside that class as well. Basically, it's kind of a multifaceted program. Let's see, I'm not sure if I'm logged in right now. Nope. Oh, wait, no, I am somewhere. Hold on. I got too many pages open right now. I was working on a bunch of projects already. Yep, there it is. I'm already logged in here. So if I go over to members, because again, I am logged in already. It's okay, guys. And go into E-mini Think Tank, you'll see that the multiple parts of the E-mini Think Tank is, like I said, live class Monday, Wednesdays, and Thursdays. We meet for 2 hours from 9 a.m. to 11 a.m. To do practice on the markets and see what opportunities are out there. Plus, there are a bunch of educational pieces to it. And basically, if you go ahead and log into that program, you get access to all the education, which basically teaches you a couple different ways that I view the markets and opportunities I look at in the markets. And one of those is futures options, which is a way of reducing your risk when it comes to the markets, or even hedging, if you will, with the using options on positions you might actually have in your futures accounts. You may not be aware of this, but you can actually open up futures IRAs and create investment opportunities using futures. And by the way, everything I do also has documentation that goes along with it. And one of the newest pieces I just included is right here, Market Opportunity Options Planner. And that's kind of a neat little tool. And I was using this in the class. You can see that we were looking at a couple different trades, and it is set up for long options, so calls or puts, bull spreads, bear spreads, straddles, strangles, iron butterflies, and iron condors. And it helps you kind of track and plan out the trades that you're seeking in the option strategies. Um, and of course, let's see, let me go into, where's my worksheet here? Where are you? There it is. Oh, wrong one. Well, this one will work too, but it's not the updated one that I wanted. I've also been tracking a couple different strategies that we've been placing in different securities and comparing. And that's the thing. We're actually learning a lot about the options that are available in the futures markets to be able to get to, again, either reduce risk or create income opportunities. And let me go to the other one that I wanted, because I'll share that with you as I go through this and make sense of it all. There it is. So right now, again, if I go to my platform, there we are. You can see, wow, the markets are just diving like crazy. And we were actually taking advantage of that right here in the E-mini Think Tank. First of all, one of the things I do is every session before the class begins, we identify trading opportunities. And I put out, let's see if this is the right one, these trade ideas, and they're also emailed to students. So if you can't make it to the class live, you still get the trade ideas. And yeah, this was one that we put out on the 5th. And you can see on the 5th, unfortunately, the 60-minute trade ended up with a loss. And we used the M2K rather than using the full-size contract, again, because of the risk. If you take the full-size contract, This is times $5 a point. It would be times $50 a point. So you have a much greater amount of risk as well as a much greater amount of margin. So looking at the individual market, if you want to trade the Russell 2000 right now as an overnight, you have to come up with $9,300 for one contract for your overnight margin. Well, the micro, which we're viewing, or not viewing here, but we were using, is M2K. And you can see it's only $939. But what happens is your tick value and size, well, not the size, but the value drops dramatically. It's 1/10 the size. So instead of a $50 tick in the RTY, point value is $50, $5 a tick, it drops down to 50 cents per tick in the micro. So you're still getting the same kind of rate of return, but it is not the dollar amount size because you're also not using as much capital. Now, the nice thing is we can actually reduce that risk even more. And one of the problems is, for instance, if you want to sell futures, right? In this case, we were looking at a bearish strategy, right? We've got two right here. The 60-minute one, unfortunately, got violated and it was a loss. But this one is actually open. I think we might have hit our first target already, 2381. We're about to reach that first target right there. As you can see, prices are collapsing into that. This is a 4-hour time frame trade. And unfortunately, there was also another strategy we were trying, which is the Iron Condor, and that went in the money. So go ahead and do that. Get rid of that one for here. But yeah, this is the trade idea that you just saw on the 4-hour. We were looking at an area of what we call supply. So additionally, when we are trading options or futures, it doesn't make a difference. I still start off with the same basic steps. So when it comes to trading options, and it doesn't matter, like I said, if you are trading options on stocks or options on futures, step one is, are you bullish, bearish, or neutral on the underlying? Okay, when you're trading options, the options are a derivative. They derive their value from something else. So you're trading options on futures are deriving their value from that underlying futures contract, basically. And first of all, an options contract is nothing more than a contract. A contract has to have 5 things. You have to have a buyer, a seller, you have to have something being exchanged, you have to have compensation for that exchange, and you have to have an expiration date. Okay. So I'm sorry, bear with me one moment. Be right back. Well, okay, sorry, I'm dealing with my animals. Some are not feeling well right now, so I can take care of them. Anyway, so you can see that, again, are you bullish, bearish, and neutral on the underlying security? We deal with these contracts that derive their value from the underlying, and the contracts allow you to deliver futures contracts or buy futures contracts at a set price. Secondly, once I figured out if I'm bullish, bearish, or neutral, that helps me identify some strategies I might be able to employ. Then I try to figure out, are options cheap or expensive? And basically, some of that is implied volatility. Is implied volatility high, is implied volatility low? And then number 3 is choosing the right strategy. So I need to choose and implement the right strategy. That's pretty much it. And I cannot spell today, apparently. There we go. There we are. Anyway, hey, Lucy. Sorry, my dog wants to get up on my lap now. She's not feeling great. This is Lucy, my Frenchie, one of my Frenchies. Anyway, she's a little bit older and moving a little slow today. But anyway, so I choose and implement the right strategy, basically. And so in this case, we were bearish, obviously, as prices were coming up into what do we call an area of supply. Now, the neat thing about all this stuff that I'm talking about is you don't necessarily have to understand it right now. And oh, hey, Brian, good. Everything is good. Hopefully you are too. But you can see inside of the Wealth Builders HQ E-mini Think Tank program, inside the trainings, I have things like, where is it here? I gotta get this organized again. There it is, supply and demand. So the reason why I was bearish is two reasons. One, because of the trend, which again, you can learn about trends and trend troubles, how to identify where there might be turning, as well as supply and demand. That's the entry and exits. And then, of course, lay on top of that the options information to learn how to trade them properly. And there's the documentation that goes along with it. It's actually under here, I think. Yep, leg-based zoning technique and trend reversal notes. So you learn how the components come together to be able to trade, and then now you could add in some of these odds enhancers, if you will, or even risk management tools like the options to be able to trade. So again, just at the basic of this, we saw an opportunity where on the 4-hour chart, we were coming into an area of selling pressure that we were likely to see the markets drop and had our targets identified. Now on the micro, we had $90 of risk. And on the full size contract, it would have been $900 of risk. So to reduce that risk, instead, we decided to do some bearish strategies. And again, we have a couple different ones available. And actually, before I go into that, let me find, nope, which one is it here? I think it's right here. Yeah. Like I said, there's some education that I do on options. And if you want more details, like I said, it's in the E-mini Think Tank class. But some of the basics when it comes to options, I mentioned before, options are contracts. Basically, a buyer pays a premium for the contract to own it, and the seller receives that premium. The buyer gains rights by buying that contract. The seller assumes an obligation by receiving that premium and taking it in. And options are options. It doesn't matter if you're trading options on stocks, or if you're trading options on indexes, if you're trading options on ETFs or futures. They're all the same. They work the same way. All the same strategies work. The same math is used as well. But the cool thing is when you're trading options on futures, first of all, you can trade nearly 24 hours a day because the stock market is only open for 6.5 hours a day. And the options on its stocks are only open during that market hour. Futures are open nearly 24 hours a day. And guess what? So are the options on futures. You can trade them nearly 24 hours a day, which means you have protection overnight and you can get into positions without having to worry as much. With a stock, you can put in a stop loss, but when the market closes, your stop loss doesn't work until the market reopens the following day. And you can get gaps, you can get wars, you can get all kinds of announcements, tariffs, things like that happen. So to protect yourself, again, trading futures, the stop losses work when the markets are open nearly 24 hours a day. And yeah, they're a little more complex, but if you have the right mentor and guide to help you, they're not really that bad. So basically, the big difference between these two, first of all, is what they're trading on. When you trade options on futures, well, first, options on stocks represent 100 shares of the underlying stock. Options on futures represent one futures contract. And that's where it gets a little more complicated, or complex, I should say, not really complicated. And the reason why is if you go out to the CME group right here, and in the CME group, I'm going to go to search and do contract directory because there's a tool called the contract directory and calendar tool. And it gives you a little bit more detailed information about the different securities that are available through the CME. So for an example, if we want to trade corn, you can see right here, we have corn. Well, the typical corn symbol is ZC for the futures, or C, depending on where you trade through. However, if you want to trade the options, those are OZC for the symbol. They actually have different symbols because they are separate securities. Makes sense, right? You're trading an option on the underlying. Sorry. Let's go click on that. And you can see there's a lot of different options available. Okay, I mentioned that OZC is the typical symbol that you want to use. Well, looking at this, what happened here? Oh, there it is. There is OZC, and then you've got the letters after Z5. Well, that works the same as it does in futures. Z is December 5, 2025. If you look back here, you'll see X5, that would be November 2025. And what you'll notice is this December option expires in November. It's kind of like futures. They don't necessarily expire in the same month that they're labeled. They could expire in previous months. Bear with me again, sorry. All right. Dogs are being indecisive whether they want to be inside or out. Whatever I try to let them do, they want to do the opposite, apparently. So when you click on this, for instance, if I click on the OZC in this calendar, again, it's called the contract directory and calendar tool. You can see that it shows corn options, tells me how many days till expiration, when it expires, and it tells me some more information about it as well. I can click on future and it shows me what futures contract that is written on. So this is the underlying security. And notice the expiration day is different. It's 35 days. Here it's only 14 days. This is also very important as well. What is that? American. Well, what it means is the style of exercise. So again, if I go back, exercise style, you'll notice with ETFs and stocks, we only have what are called American style expiration or assignment exercise. Basically, that means when you buy an option, you have the right to exercise it whenever you want, as soon as you own it. The problem is if you're a seller of options, that means you are obligated to be to assignment at any time if picked. Well, we can avoid that and reduce some of the risk by doing European style options. European style options can only be exercised at the expiration of the option. So you don't have to worry about that early expiration or sorry, early assignment. So again, you could choose that type of option. Right here, we can see that corn, this particular option is American style. What does that mean? As soon as you were to sell that option, you have an assignment risk. Now, with greater risk, you'll get more premium, but it may be something you don't want. So you could choose perhaps another option. And all these apparently are still American styles. So if we go back, we can look perhaps at energy. Let's see, is nat gas? Can't remember if it is or not. Yep, there it is, European style. So what does that mean? Well, European style cannot be exercised early. If you sell that, you do not have to worry about assignment until that option actually expires. It's one less thing off your mind. So you can be a little bit more free to, well, just a little more peace of mind, really. The other thing is options expiration method. The last one we looked at said physically delivered. This one's saying financially settled. So when you say physically delivered, what does that mean? Well, again, go back here. I think I can just go back. Oh, nope, I went too far back. Didn't do it right. So we'll go to corn again, and I'll click that corn. Oh, wrong one. OZCZ, there it is. So here it is. And what it said actually is deliverable. So American style is the exercise, meaning it can be exercised at any time. Deliverable means when that is exercised or assigned, you will actually transfer the underlying contract. So if you were to be buying a call, for instance, and you would exercise your right to buy, you would get to buy futures contracts at the strike price. If you were selling that contract, you would be obligated to deliver. It's just the opposite for a put option. And it's the same. Calls and puts are the same in stocks as they are in futures. But the other style was there when we just took a look at nat gas. And on nat gas, let's see, which one is it? LNE, where are you here? There it is, LNE Z5. That's what I was looking for, the monthly. And again, we zoom in on this and you can see that first of all, oops, come on. This is European style, which means there's no early exercise. So you don't have to worry about getting assigned if you sell short on those options, and they're financially settled. Financially settled means you do not receive contracts at the assignment or exercise. What happens is Loser pays the winner. It's cash settled. So you don't have to worry about dealing with an underlying futures contract. See, that's just something that you do have to be careful of because, for instance, if you decide you want to buy a futures option, and there's another tool, again, CME has a lot of great tools. Go into the customer center here. If you're trading options, you need these. No, what? How's that not found? There we go. They have a margin calculator, which you can use for options and futures. So let's say we want to trade that corn option. Oops. Give it a name here, corn. And again, in the class, I actually have videos on how to do all this stuff. So I'm not trying to teach you right now. I'm just trying to showcase what's available and some of the education you could possibly get if you decide to join me in the mini think tank. So let's say we're going to do the March 2026 contract. This is a future. Okay. So if we look at the future, one futures contract overnight would cost you a margin deposit of 1,018. So let's do this. Open. No, not open. New. Blank worksheet. There we go. Corn future contract. In that case, what did I say was 1018? Oops, what happened there? Oh, margin. Now, the margin doesn't necessarily mean the risk you have. Your risk is based on where you're placing your stop loss. And of course, your profit will be where your targets are. So we could do a corn futures contract. There is a way of reducing some of the risk as well, because again, if I go into my option or my contracts here, let's do a mini corn contract and just compare that. Oh, not that one. I want this. Sorry, it's micro, not mini. I think there is a mini though, isn't there? Let me just do this again. Clear all. Mini size corn, and there's a micro corn, so I can add that one in as well. So once again, I'll just do the March 2026 contract. And this is one of the ways we can adjust our risk when it comes to our positions. We could take smaller size contracts. So looking at the mini, our margin is going to be $204. That's not bad at all. Oops, come on. So mini corn, $205. And of course, we have micro. If I could spell. Geez, Brandon, what's going on again? Just fat fingering it. So let's see. There we go. Fat finger means it's a trader term, meaning you hit the wrong key. Micro corn. And you can probably find a lot of these margins online as well or with your brokerage. But what will happen is when I get to the options, this is where you're going to need to go. So again, micro corn futures, March 1. And let's see how much is that. It's going to be very small. And it is $102 for margin. Come on. There we go. Now, going back, we could actually trade options on corn. And we'll just call it ZC option. And we'll look at options on the same security. So now I'm going to go to option for corn. And again, March 2026. Let's do a call option. And we need to know the strike price. Well, the current price of corn is what? Let's see. I don't know it off the top of my head. So I will go to a different page for this. Oh, there's ZC right there. And it's 428.50 right now. And that's not the right contract though. So H26, got to get the right contract as well. 443 is where we're sitting right now. So for the strike price, let's say we'll do a call at 443 or they're nearby 445. And for that one call, and remember, this is the full size contract, not the mini or the micro. We could also look at those as well, but we're not going to spend too much time on this. Our initial risk margin is $562. So that is the horn call in $562. So it's half as much as it is for the full size contract, but you're still basically controlling one futures contract because that's the option. Okay. If all the positions are open at the same time, what's the approximate margin? It just varies. It depends on when the orders hit. When I'm looking at the tracking on the futures contracts for the E-mini think tank, let me see. I've got my tracking sheet somewhere here. Let me open it up. So if we go to, nope, E-mini think tank, there we go. Now, November hasn't really gotten too many open yet. So let's take a look at the October, which I should have here somewhere. There it is, think tank October. Because that's a great question. How big of an account do you need to take advantage of all these opportunities that are being put out there, right? Well, you have to look to see the dates and what overlaps. So for instance, on the first, we actually did have quite a few open. We had the 10-year, we had soy meal, because they're all showing open on the first. And we had Kansas City wheat and feeder cattle. Well, again, you could just look at the individual futures contracts to see, let me do this to get those futures contracts margin, and I'll tell you. Now, do you have to trade the full size either? No, of course. You could actually do the micros if you choose to as well. So let me move this off to the side, and real quick, we'll look at grains, feeder cattle we had. Not grains, excuse me, that's soy and soy meal that we would have. The margin is 100. I'm sorry, that's the point value, $1,700 there for the overnight. That actually ZM was one was an intraday trade, and no, both were intraday trades that got stopped out. But if you were prepared to go overnight, again, on the soy meal, let me do this. We had ZM, GF, KE, and ZN all open at the same time. Right? GF, KE, ZM, ZN. Perfect. So ZM, as I was saying, had a margin. And this is just one example, of course. Oh, there's 1760 for KE. The ZM, soy meal, 1705. Under livestock, GF is 6,600, sorry. And not everybody trades that one because it is a lot more risky than some of the other securities. And then we had, sorry, the 10-year, right? That is 2062. So for that particular day, and this is not necessarily an example of every single day, but we have, let's see, some L3, L7. What did I do here? It's the sum of L3. Oh, to L6, sorry. There we go. $12,000 is what you would need. Honestly, with the $25,000 account, you'd be able to do all the contracts that are available at almost any given time. And when I do the trade tracking, I think, let me see, I have it tracked as a $15,000 account and also, sorry, yeah, $15,000 and $50,000 accounts for the tracking purposes. But again, there's nothing saying you'd have to do the full size contract or take all the trades. Of course, you don't have to. And you should probably start off in simulated mode just to practice as well. So anyway, getting back to where I was with the futures, you can see that the margin is much, much lower. And that's one of the reasons why I'm also focusing on futures, because if you want to trade the full size contract but don't want to have as much risk, you can do the options. And we can even reduce that. Now, take a look at this. If I do something a little different with the option, which is actually what I focus on a lot more, we'll do corn full call spread. And I'll show you a little bit about that in just a moment as well. So once again, we're going to do options, corn. The first one we were doing was March call, 4.45, right? Where was it? 1. And then what we can do to reduce our cost is on the same option series, the calls for the March 2026, we can do a different strike price above where we expect prices to go. So maybe we only expect it to go up for a little bit to about, I don't know, 535. Add to preview, margin. This is what's called a vertical spread. You use one option to offset the risk of another option, as well as reducing the cost. And it's interesting, this one is the same. That shouldn't be, unless I did something wrong here. Let me make sure. Usually it's going to be lowered. Thank you, John. And why is this not showing me the individual's legs? I don't know if I did something wrong here. Let me take a look. Valid trades, corn option, buy, sell. That's interesting. The margin happens to be about the same on this one. Normally it's not. Normally you'll have lower margin. It's $509 for that spread. And it is a little bit less. Bear call spread. Again, 509. So we can reduce our risk and reduce our costs. And one of the other ways of reducing risk is by looking at the option itself. By the way, if you click on the link, there is an opportunity to try out everything in the E-mini Think Tank for free. Right here, you click on that link that was posted a little while ago by Andrew for E-mini Think Tank. If you sign up for the monthly, you just pay the normally monthly fee. But if you do the quarterly, you can actually see right here, we offer a 2-week free trial. So you don't get charged for the first 2 weeks. Now, obviously, you have to be able to afford it and be able to do the trading, but or at least practice. You don't necessarily need to do the trading right away. You definitely want to practice the strategies before you get into them live. But anyway, what I was talking about when it comes to risk and the platform, if I go here to trade on corn, come on, there we go. Any Black Friday deal? I don't know. We just did one for the other program. I don't know if you can email us and we can talk maybe. I know there was one. I got to check my schedule to see if there's another special coming up or not. We might be doing something. So you can always email us if you got questions on anything like that. If you're interested in more about the programs, it's support at Wealth Builders HQ.com. Email us and we'll talk. So anyway, looking at corn, as I was saying, oh, it's ZC. That's why I didn't show up there. You can email me, Brian, if you're interested in rejoining as well. But basically, when we look at these options, let's just look at it, the March options like I was just talking about. So we go, and there is now you got to pay attention to the underlying security because the expiration is for the option, but there is the underlying security. We actually have March options that are tradable on March futures on November options. But I'll do this January one. It's a little further out. And basically, what happens when you're trading options is you can measure your risk, not just from the charts for supply and demand, but also right here in what we call the Greeks. These are risk parameters that affect your options. Now, this is kind of interesting. If you go ahead and let's say we buy that call again, what do we have there? The 4.45 call? It's right there. And you want to buy that call. First of all, there's the strike, 445. Technically, it's 4.45, okay? And John, actually, I think you emailed, and I was going to respond to your email. Let me check. Is that yours? Oh no, somebody else's. Maybe. The boot camp does have this. No, it's basic futures for the boot camp. If you're interested in learning my strategies like supply and demand, that's actually here in the E-mini think tank. When you go to the new trainings, right there it is, supply and demand and trends. Yeah, so if you have a little bit of basic knowledge of trading futures, because that's all the boot camp is, it's just the basics of what futures are. If you want to know how to trade them, this is the program, the E-mini think tank. And that has all the actual strategies that I do, supply and demand and everything else. So that's here. Yeah. Plus you get all that other stuff. So it's kind of cool. What platform do I trade on? Both TradeStation and Thinkorswim in the class. It just depends on what the students are using as well. And I try to be accommodative to everybody. And I've got videos for the different platforms as well. So basically, right here, this is one of the biggest differences in options on futures versus options on stocks. The premium that you see there. Okay, when you go to buy an option on stock, you would simply multiply whatever number you see for the premium by 100 because it's 100 shares. Well, here, that is multiplied by the point value. And every single security in futures has a different point value. So this, let me see, do I have my calculator still open? Yes, I do. There it is. And I have a few too many tabs open right now, I think. Anyway, there you go. You can see that 11.875, we would multiply that times $50. And right now, to buy that option, it is 593.75. When I looked at the margin just a while ago and put it here, you could see that it was actually right about that. It was 562, but because of what's happening in pricing, it went up a little bit to 593.75. Okay. The same thing with the spread now. Let's go back and I'm going to do what's called, oh, by the way, before I go further on that, let's do it this way under Analyze, Add Simulated Trades. That'll make it better because I can actually compare. Make sure I don't have any open ones first. And we want to go corn. CC. That way I'll be able to show you the differences. Nope, nothing yet. Okay, good. So we go to the option chain again, and I'm going to select that March contract that expires, sorry, the March underlying with the January expiration. And again, the 445 call, there it is. And the Greeks, the risk parameters, let's see, we go into risk profile here, we should see them. This is the current price, I believe. Actually, where's corn right now? H26 is at 442.75. So 442.75, we have a delta of, that's not right, 24.7. Hold on. Just need the option. I can just see it here in this add simulated trades. So right now, my Greeks are telling me that for every 1 point or 1 penny that corn moves in price, I'll make or lose 49 cents on the option. This is a rate of acceleration for the delta because you see the deltas change depending on where the options are and the underlying price is. Theta is time decay. With an option, it doesn't matter if it's stock or futures, options are a wasting asset. It's like an ice cube coming out of the freezer. It melts. So they lose value. And this is going to lose 8 cents every day that you hold it. And volatility impacts options pricing. That's pretty high. That high volatility means that we could get a lot of exposure. If volatility jumps or drops, it'll change the pricing of our option dramatically. Okay, and we can see that, changing this volatility here. It should change my price slices. For some reason, it's not. Let me do this. Or maybe not. Come on. Anyway, I was trying to compare. There we go. See if I can do it on TradeStation a little bit easier. Because sometimes this looks a little confusing. And with TradeStation, I can actually show it to you a little bit differently. And sometimes it's a little bit cleaner. Just depends on the platform or the security we're looking at. So that'll take a moment to load up. And while I'm doing that, again, I'll go back to talk about the differences. Settlement, again, we can get delivery of an underlying futures contract or cash settled, which is cool. You don't have to worry about underlying stock. And that's something else I wanted to mention, because when you're dealing with options, come on, there it is. TradeStation keeps popping up because it's loading up. There we go. Now it's up. So it should stop interrupting me. But right here, you can see that, no, you can't because TradeStation's in the way again. Again, when you have the delivery from settlement, you would have to change the amount of margin you put in. Remember, when we bought the corn futures or the option, we only needed about $500, $600 of margin. But if you actually exercise or get assigned, you have to have the margin for the underlying security. And if you don't have that money, well, you could get in trouble with margin calls. So you got to be careful with that. Same thing happens with stocks. You might have the ability to buy the option for a few $100, but if you're assigned or exercised, now you need to have the money to buy 100 shares of that stock. The margins change very dramatically. So you have to be very careful. And I've already talked about the day trading rules. The other nice thing is if you trade options on futures, you don't have to have $25,000 in your account. You could actually trade futures options for about $2,000, $3,000, depending on what you're trading. And there's no pattern day trading rules. So you avoid that issue, which is nice. I mentioned I was going to go to, here we go, OptionStation Pro to demonstrate the Greeks a little bit better. So we'll go into CH26, which is corn 2026. And there's that January option I was just looking at, 77 days left till expiration. So again, if I buy the 445 and go to analyze here, there it is. That's the call option I was just using. And there's my last price. Let's just get rid of the other. Actually, keep one. And this is going to show me at expiration, my break-even point, roughly there. So basically right now, you buy this option for $587.50. That's how much it would cost you right this moment to buy this. It's 11 3/4. You got to convert from that into decimals. It's not a big deal. My break-even price on this call option is $456.75. My Greeks, well, first of all, my delta is 50. That means for every 1 cent that we go up or down, okay, then basically we will make or lose $50 on the options premium. Okay, that's right here, our max loss or max profit. And basically how much profit we're going to make is along this line. If the time decay, well, time is time decay, how much we're going to lose every single day as prices go by. Or sorry, as time goes by, not prices, excuse me. So again, when you take a look at the option here, you can see that I have a time decay of 8 cents. I don't know why it's not showing on the other page. And volatility we saw was about 82 or 81 cents right now. Well, John, again, I would be more than happy to answer a lot of your questions. Email support, and they'll forward it to me and I'll help you out. Right there, support at Wealth Builders HQ. Sorry, it's wealthbuildershq.com. I typed that in wrong. There we go. That's the right email address. Now, I was saying that what we could do is sell an option and at the same time buy an option. Now we have a vertical spread. Our previous risk, and now we can compare the two side by side right here. That's where we want it, right here. And first of all, let me do the break even on this one. Notice the break even before was 456. Now our break even for the spread is 450. Yep, right there. So we've dropped our break even by 6 cents, which is a pretty big move when it comes to corn. That's one cool thing. Secondly, we dropped our cost. By doing the vertical spread, remember the margins I was just showing you? Well, I didn't do them correctly on this, but right here, doing that vertical spread for corn, the initial cost right now is $587.50. However, if you use the vertical spread, it is only $262.50. So now, remember, we're dealing with the full corn contract, which has a margin normally of $1,000. But if we do a vertical spread, we cut that in a quarter, or it's only 25% of what you had before for the margins. So you got an opportunity to reduce dramatically. Absolutely, Brian. Thank you. Take care. So here's the other thing we're dealing with: directional risk. Remember, if prices were to go against us, we lose that delta. And it is 24.30 right now. I guess I picked an out of the money option. I didn't realize it was that deep out. But that's the 445 strike. So for every 1 penny, we lose that much money. Well, with a vertical spread, not only do we reduce our amount of risk because we reduce our max loss, cut it about in half, more than half. But look else what happened. We reduced our risk when prices go down against us, but we also reduce it as it goes up against us, or up for us, excuse me. Okay, anytime you reduce risk, you reduce reward. So that's kind of cool that we're able to control our risk a little better, because what happens is this is called the anchor leg. Okay, this blue buy opportunity at 445, that's the same in both sides right here, the two different strategies, either the single or the vertical. But when you do one option, you are stuck with whatever the Greeks are. So again, right here, it's 24 for the delta. Time decay, every day we lose $4 in premium. So out of that $587 that we paid originally, if prices go in our favor, we're still losing $4 every single day we own that option, no matter what. If you do the spread, you're only losing 29 cents. That's a big difference, isn't it? So especially when you're thinking about, well, let's go here. Nope, wrong one. There. We have, what did I say it was? 4.09 divided by 587.5. No, that didn't do right. 4.1, it rose a little bit, divided by 587.5. And that is basically 0.7% of, that's what you're losing every day. 0.7% of your premium every day. And that just grows. Okay, the closer you get to expiration, the higher that theta will go. Now, if you are trading the spread, that is now 0.32 divided by the cost, 262.50, and that is 0.1%. So either 0.7% every day, almost 1% of your money is being burned away by time decay for no reason, because you just did a single option. But when you do a vertical spread, now I'm losing less than 0.1% every day for time value. I neutralize that Greek. I also reduce my volatility exposure. Look at that. Volatility, Vega is 40 versus 4. We cut it down to 1/10 of what it was. Cut it down by 90% by just doing the vertical spread. The problem is when we reduce the risk, we also capped our gain. Okay, when we just did the single call, you can see on the risk profile, that means that we have potentially unlimited profits. We could go up forever and still make money. But is that realistic? No, we're not going to go up forever. It'll stop somewhere eventually, and the option will expire. In the vertical spread, though, you see we only make money until we reach the option we sold, and then we're flattening out. Can't make any more than that. So we cap our profit, but we reduce our risk dramatically. And that's exactly what we did in this trade. Again, I was looking at the Russell 2000. So let me go to my monitor here. And come on, there you go. Good girl. So in this particular opportunity, there were several different trades we took on that Russell 2000. The first one was simply buying a put. And in buying a put, right now, that's making $2,100 profit. So these are all the trades right here. That's the Russell 2000. I need to rename that one actually. But anyway, you can see we bought a put for $3,800. and our max reward is 123,000. That's if prices go to zero. They're not going to go to zero. But right now we're up $2,100, it changes obviously. And we have certain risks, our delta, the vega, gamma, we can see all that right there. So to reduce the risk, we did a bear put spread. And the first bear put spread we did, notice the profit is $1,500 right now. But what happened is the cost, bear put number one, was, is this the right one? 2450. Yeah, this is this one. $1,300. So we went from a cost of $3,800 to $1,300. Yeah, we cut down our profits, but we reduced our risk. Notice if we hit a stop loss, which we actually have for this as well, we actually will lose $723 by just buying the call or put. If we do the spread I just mentioned, we only lose $338. However, our reward at our target is also going to be different. You can see reward at target 1, 2,400, reward at target 2, 696. The rate of return is what to focus on though. We're using $3,800 to make that profit, so our rate of return is 62%. Here, with the put spread, our rate of return is not that much lower. It's 50%, but we used a fraction of the money that we had before. Well, a third of it, basically. And we also had another spread available. And we also did another option where we basically did selling options in order to be able to collect credit. And in this case, we had two different ones that we did: bear call spread, number one, and bear call spread number two. They're going to have a lot less profit right now, $140 and $145. But in this case, when we got into the position, we were actually paid to open the position. So our cost to enter was much lower. Let's see, where is here? Our max risk in this one was $200 to get in. So our rate of return at the target is 318%. The other one is 100%. I think that's off. I think that's wrong. But this one is right, 318% rate of return. So if you really want to limit the amount of capital you are using, you can do that with the right option strategies. And as I said before, one of the tools that I created inside the E-mini think tank is this market opportunity plan, where we're able to go in and learn the option strategies and there's instructions, of course, but by following these. So for instance, we had bear call spread. This one was on gold. But if I go back and do the bear call spread that we have right here, there it is. Not hard. This was RTY. Underlying point value in the future is $50. We're using calls. The long strike that we did was the 2,500 call. The short strike was 2475. For the long call, we paid 65.20. Remember, you have to multiply that by the point value for the actual number, and we basically sold for 78.10. That means that our credit received was $1,290, or a total of, well, $645 was received. Our maximum profit is at $645 if those options expire worthless. Our maximum risk is the difference between the strikes minus the premium, or $605. Now, we are not actually getting out right at the maximum profit. We're not waiting for expiration necessarily. We're getting out when we hit our first target. And you probably didn't notice, but I'll show you here. You can see we have a stop loss identified that we know we're wrong. We're going to get out. We have target 1 and target 2. So depending on how many contracts you put on, you can do multiple contracts and multiple targets. So our stop loss, and this was actually adjusted since then. This was on, what did I do here? Oh, that's the gold one. Never mind, that's why. So again, for the stop loss, we had 2494.1. And it was 2387.2, I believe. 81.2. I was close. Now, how much are we going to make or lose depending on where we are? Well, if our stop loss is hit, let's find out. right here, I can go into analyze and risk profile. I have to go to the right security, RTY. There we are. And I just have to find the right options. These were oh, there they are, 2475 and 2500 calls. Make sure that's right. 7810, 6520. Yep, 6520, 7810 is perfect. So now I have what we call price slices to tell me. And by the way, I can see my break even and risk profile right here too. That automatically populates for me. I can fill out a whole like ledger, if you will, or keep track of my trades by doing this. It's pretty cool. So scrolling up just a little bit there, and whoops, didn't mean to do that much. Here are my price slices. My stop loss, 24.94. I would lose $44 right now. Again, things are changing because of volatility and prices. So it's roughly $44 I would lose. My potential profit right now, 233.78. So it's not 100% that I was going to make. The 100% maximum profit is 645. But you can see based on my risk to reward, that's a 5.3 reward to risk ratio. Even if I do get out, yeah, Lucy was barking at the door. She's my guard dog. Even if we do get out, like I said, at a $233 profit, we use $600 to get in, right? Well, what is that rate of return? 233.75 divided by 605. That's a 38.6% rate of return. 38.6% rate of return. And again, that is half as much as what we have with the long put, but probably better than what we get if we actually did the underlying security itself. Just go ahead and shorting the Russell 2000. Because again, if you want to short the Russell 2000, you've got to have the margin to do that. And in this case, that margin for the Russell 2000 overnight, $9,389. I can go one step further here. Okay. If you were to get in and our entry price for this, let's see, where was it here? Just one more thing to check. Restore cells, and then we got to call it for a day. But right here on the Russell 2000, maximize that. We were looking at an entry price on the trade idea, 2475.8, right? 2475.8. Our target, 2379. No, sorry, 2381.2. That means we're going to make 94.6 points, again, times $50 a point. That's $4,730 that you would profit by shorting that contract. Now, I did pass it. The rate of return we just saw was about 38%, right? By doing the one option trade and hitting our target. This is not necessarily, that's not what I was looking at. It was the bear call spread that we just did. It was 38% or something. This one, if we do the underlying security itself, the Russell 2000 again, RTY, 93.8960. That's a 50% rate of return. So you could use $9,000 and get a 50% rate of return, or we use what, $600 to get a 40% rate of return. I think it's a pretty good use of your capital. It's not the same rate of return, but it allows somebody with a limited amount of capital to be able to participate in the same kind of trade. That's pretty cool. So, oh, thank you. I appreciate it, John. Yeah, definitely need to do that. I appreciate the compliment there. John was just saying that he was admiring some of the stuff that I've been doing with when it comes to what I do when it comes to the mentoring and teaching. But thank you very much. Yeah, no, I need to get more involved in some of the online marketing and even the whatchamacallit, TikToks and all that other stuff and YouTube videos. But anyway, I gotta go. I gotta run. Hopefully, I give you guys some more insight into what's going on in the world of options on futures and show. Like I said, we go into the much more detail, and I try to provide as many tools as I can to help my traders and my fellow traders out. Basically, you guys are kind of my family, and like I said, I put together these spreadsheets, and the nice thing is you can download them inside of the E-mini think tank absolutely free once you are a member of that. And you can try out the E-mini think tank for free as well. So if you have any questions, let's see, I can go ahead and answer those. Problem is the trend. Oh yeah, the trend train gets you. Yeah, basically it depends. John's asking, what's my simple multiple time frame analysis that I do? Well, again, that's also detailed in the classes, as I showed you before. I do have under trainings, trends and trend troubles and even targeting to know where to get in and out. And then you combine that with the supply and demand. I actually am putting together a document on what's here, what order to watch everything. But basically, yeah, when I'm trading intraday, it varies. This was a 4-hour swing trade, obviously, so it was overnight. I do a lot of intraday trading on a 5-minute time frame, and I subscribe to Dr. Alexander Elder's vision of multiples of five. So I stick with you usually, excuse me, time frames by either 4, 5, or 6. So if I'm trading on a 5-minute chart, that's my trading time frame. I'm going to be relying on the 30-minute trend to tell me which direction to go because that's a multiple of 6. I don't use 25-minute charts because it's not very popular, obviously. And then from the 30-minute trend, that will continue until it reaches the 3-hour supply and demand. That's what I call my perspective time frame because I need to know where the trends are likely to end. And this is detailed, like I said, more in the class itself as well. But typically, I'm always looking at a multiple of 4, 5, or 6. So if I did 15 minutes to trade on, I'd use a 60-minute trend, and then I'd use a 4-hour perspective to let me know when the train is going to turn, so to speak. So yeah, that's kind of what I do to simplify it. That's the best, easiest way to simplify it right there. But great question. If you have more, like I said, you can go ahead and email us support@wealthbuildershq.com. Forgot that before. And I'd be more than happy to answer more of those questions you might have. And like I said, if you're interested in joining the program, please let me know. You can email us there as well, and we'll see what we can do to get you going. We do offer that 2-week free trial so you can kind of kick the tires and no risk in order to be able to see what it's all about. So with that, have a great week and well, rest of the week it's almost over and weekend and trade safe and trade well, everyone. So thank you for being here. I appreciate it.